Now, here's why we're bullish. We're turning under the hood. We are turning bullish. The market is pricing in the rate cut, period. So we have advancers. This is advance versus decline versus the S&P equal weight. I look at equal weight because it equal weights all the 500 companies, best companies in the S&P. Therefore, you're getting a better read on the health of the overall market. We've been downtrending, but at that same time, advanced decline. So this is how many stocks are advancing versus declining has been rising. Now we hit all-time highs literally today. This is Wednesday, November 26th. So you're breaking out. Advanced decliners is telling you this is a leading indicator. The price is saying that, hey, there's more buyers than sellers for sure. Where the buying pressure is picking up. And I think a lot of that is the performance chase. Going back to September, okay, we zoom in here a little bit. You can see it. Fund managers were down so much on their gains, right? 2021, they outperformed up 60%. Only 22% of active funds, this includes mutual funds, are actually beating the market. So let's just say 80% of funds are underperforming. So what they do is they start to buy the stuff that was already working. We're going to look at a couple of those stocks later. A lot of the chip stocks and anything that's driving the AI narrative right now. So yeah, they're going to chase. We're seeing that chase happen in real time. Okay, we're seeing it in real time. Why? Because advanced decline, all-time highs, right? They're chasing those stocks. The bull market is expanding. Did I show Nvidia on here? Yeah, this is very important too. I kind of missed this. After Nvidia's earnings, Nvidia sold off and the market expanded, right? It broadened. So there was actually more stocks rising, more variety of stocks rising after Nvidia earnings. That's a good rotation. They're not holding on to their buying power, buying bonds. They're buying, equity bonds, but they're also buying stocks. So that's a good, healthy signal for market separation expansion. This is when the short-term breath, right? The amount of stocks moving over the 20-day moving average. So the short-term breath, the more volatile part of price action is moving above the 50-day, right? So this is just always an expansion for at least a month. You get at least a month and a half, maybe 90 days when you get the signal. We just had that signal. Now we had it a couple times, but it did not stay. So we need it to be sustained, right? The wider that gap, the more bullish the market is becoming. And it's sort of like a spring, right? This spring try to unravel didn't happen, right? But once it unravels and really starts to go, you're starting to get that money rotate from sector to stock to stock to sector to sector. So we want that full expansion. We're now above the 50% mark. So more than half of the stocks in the S&P, and we'll look at the new one. This was as of yesterday. Today was even more bullish. More than half the stocks in the S&P 500 are above their 20 and 50-day moving averages. So we're picking up. We're starting to expand here. Okay. And I guess the analogy would just be like putting on the gas pedal, right? You're hitting the throttle. Markets. This is the performance chase. Fund managers, maybe retailers, millennials are buying the dip. People are buying the dip, period. On a long-term basis, we're not in the clear yet. We want the 50-day to cross above the 200 when it comes to market breadth. But when we do get that long-term separation, we almost reset back to the April lows. We almost got to 25%. We're at 30. I think 30 was low, right? Let's just say once you expand to the upside, you're in a new cycle period, which I think ends in March, right? February, March. I think we're pushed back a little bit. We might get a lot of momentum in March. I'm sorry, January, February, slowdown in March. Maybe we have a 5-10% correction in April, and then we're back up in May for some other reasons we're going to talk about, right? So this is just tracking the flow here. The whole engine starts to hum. Once you get the blue cross the red, the whole engine, the S&P 500, the equity market really starts to hum. Looking at volume, okay, when we look at the volume shelves, how much liquidity is standing at these levels, you want to see the S&P get above that 673 level. We got above it. So now I think we test all-time highs. That's the upper level of the volume weighted average in terms of what is it? It is the volume profile if you want to look it up. We bounced off the we came right off the VWAP from the April lows. So from the cycle lows, the volume, basically everybody who bought into the lows, they're buying back their stocks right here. They're buying back S&P, whoever that is, right? Fund managers, probably mostly institutions, most retail investors don't really buy S&P. They mostly trade it, but this is where they're stepping in and buying that equity. And they had, we had some nice support here, multiple sticks, candlestick capitulations here. So we broke this level. So we're back to bullish territory. I think we need to hold 673. We need to hold 673 post Fed cut. If we hold 673, very bullish. If we get below it, we're at risk to retesting the lows or making new lows, depending on how bad the narrative gets, right? The VIX, I'm guessing going forward, when it comes to the VIX got slammed. You're back under 20. So this is a good, strong signal that, whenever the VIX gets below 20 after a big spike, you might be right back in, as long as there's not any negative catalyst. We got past earnings, right? We're in the middle of a clearing event or multiple clearing events. You had earnings season, you have Fed policy, you had the government shutdown. Once the government shutdown ended, this is what started this government shuts down. Now you don't have visibility on earnings. You don't have visibility, not on earnings, on fiscal policy. You have no visibility on the damn data, the macro data. Now that we're getting that visibility, I think we just erased all that fear. Now it's all about the Fed. We need a dovish Fed. So if the Fed is hawkish, we could retest 28. Not even if they're hawkish. If they don't cut, I think we retest 28. For sure, we're going to jump to 20. There's too much volatility going into the meeting. We're going to probably test 20. And if we break, if we get crushed on 20, you got to be bullish. December 10th, I think, is going to be the most, 10th, 11th, whatever it is going to be the most bullish period, or the most clarity that we get for end of the year, new bull market cycle, where we start making multiple new highs, right? Rates are confirming that the Fed must cut. They're rolling over. Long-term rates are pricing in a dovish Fed, a slowing economy for the most part, right? We're not at risk of a fiscal deficit, right? We're not at that risk. The MOVE index represents the treasury, confidence in buying US bonds. Those bonds are getting bought up. This is the volatility index for that. When there's uncertainty over the next 30 days, it spikes. Usually there's some type of crisis. We're not getting it, right? Triple B spreads. This is people dump. If this goes up, you're getting a dumping of equity debt, and that's starting to turn over. Now we got to keep our eye on it, but I think as long as that rolls over, then you're basically getting, right, more confidence in the equity market, especially with, you hear Oracle giving all this debt out, throwing all this debt out, issuing all kinds of bonds. Oh, is it a bunch of fluff? Well, those bonds are getting bought up for the hyperscalers. Not worried about it. Also, keep in mind, one of the biggest things here, it's buyback season. Right after earnings, we get buyback season, right? Generally, it starts in the middle of each earnings season. After they all report, now they start to buy back stocks. November is the month, which is usually why we have the seasonal strength, the Santa Claus rally, they say, because you have a strong retail class, consumer discretionary, a lot more spending in the holiday season. Stocks start buying back their shares, so you get a lot more scarcity. So we're heading into buyback season, and usually get about 200 to 300 billion dollars of buybacks. That's a buyback on equities. So you're getting another buyer step in here. The Fed cuts, they're definitely buying back stock. People are buying back stock, investors, institutional retailers, and then some other signals we got that mark the bottom here. Put to call ratio hit the lowest level since April lows. Well, that's a lot of puts. They're not going to last. The peak of these puts is going to be December. Everybody's, even some of you are probably hedging for December, buying VIX December 10th to wait. If the Fed doesn't cut, boom, VIX spikes. So a lot of hedgers, right? A lot of that hedging already got caught off, because once we had visibility on the employment market, and really it was the dovish Fed, which we talked about a lot, is if the government opens, it's all about a dovish tone. We're getting that dovish tone by multiple Fed members. And on top of that, let's just talk about this real quick. We had the second highest put volume ever. I mean, that's usually marks the bottom, right? But more importantly, even if the Fed's a little hawkish, you got to keep in mind that we're heading into a period where the Fed governor is going to get announced. The new Fed chairman, will be announced. Okay, in Christmas is what they say. Who knows? It's supposed to be Christmas. I'm not sure, but that Fed governor, more than likely, if it's Hassett, that's Trump's man, they're going to be cutting rates. They're going to, for the first time maybe in history, you're going to get a Fed who's actually working with the Treasury, which is not good for inflation, or I don't want to say inflation, deficit spending, But you have, you have Besant. Besant is pretty smart. He's a macro trader. He understands how to get confidence back in the bond market, the equity market, if that were to be the case. So on a technical basis, we went through it. The market is turning bullish for sure. Underneath the hood, where we're accelerating, you got to stay bullish. You have to have more of a bullish bent at this point. You should, at least. You should be expecting a blow off top, a vicious rally if the Fed cuts. And they're probably going to cut. The market is pricing in an 85% chance that Powell cuts. There's a lot of pressure on Powell not to cut. And if he doesn't cut, then we could be retesting these lows, but it's irrelevant because by the time, we retest the lows, the market's definitely going to be pricing in a cut for January, and it's just going to be a reset of risk. There's kind of no way out. Okay, there's no way out. We should bounce here. If we don't bounce, well, something more ominous is probably happening geopolitically. I doubt it. I think the Fed has to cut at some point, whether it's December or January, and the market is going to price it in, and it's going to price in May. So I still think we get a vicious rally.